Good day. I'd like to record this session because, as you know, there's a kind of financial crisis going on in Turkey. And this crisis is crucial because this crisis is quite distinct from its predecessors. We have started observing this crisis since 2018, but it's become quite severe recently. And there is a sharp depreciation of the national currency. And there are some other occurrences in the financial world which many quarters and people should be well informed about. So what I'm going to do today in this session, I'm trying to explain you what's going on in Turkey currently, or what happened recently in the last 2 weeks in the Turkish financial markets. So I'm going to show you some slides, so you will be able to follow on this issue with slides. Now, we have to well understand what the cause of the crisis and how the crisis is. So initially, I'm going to I shall try to explain you what the true cause of the crisis is. The true cause of the crisis seems to be that the central bank has lost its independence, so it can't on its own determine the policy rate to control inflation. So this had happened explicitly since 2018. There was a delay, as you see in the policy rate. This orange line is the policy rate. This policy rate was delayed in being adjusted, the adjustment of the policy rate vis-a-vis the consumer price index, which is the blue line. So there was this delay, but eventually, at the end, there was a rise in the policy rate, which kind of remedied the surging inflation rate until a certain level. Now, the surge in inflation since 2020, has been caused by the spread of the pandemic, the COVID pandemic, and the various problems in the price inflation caused by the agricultural prices and food prices. This is a rather global issue, and there had been expansionary monetary policy alongside expansionary fiscal policy, which allowed the inflation rate to go up. But at the same time, there was a rise in the policy rate of the central bank, which was quite congruent and appropriate. But after a while, there was a decline of the interest rates, as you see in the last couple of months, whilst the price inflation was going up. So there is currently a negative differential between the real nominal interest rates and the announced price inflation. Now, the reason why I'm calling it announced price inflation is due to the fact that the announced price inflation is probably underestimating or undercalculating the actual inflation rate, because the wholesale price index is above 50%. Now, the consumer price inflation until today is something like 21%, which is well below what people feel and what the actual inflation is. And some professional organizations also have estimations or forecasting of the consumer price inflation, which is well above that. So we have a real and quite a high negative real interest rate, which causes the consumers to switch to foreign exchange deposits. Now, the movement in the foreign exchange rate can be relied or attributed to various effects. One had been in the past in the Turkish economy, the current account deficit. But currently, we don't have a current account deficit for a couple of months in Turkey. We have a current account surplus, which is quite different when with respect to our history, because historically the Turkish economy had always given, almost always, except the crisis years, had always given negative or current account deficit. Now, there isn't a currency attack of foreign capital, either short-term or long-term, whatever. There isn't such an attack because there's very little portfolio investment left in the country. So we can't talk about such a currency attack by the foreign capital. We don't observe debt revolving problems vis-a-vis the with respect to our foreign debt. Debt is revolved, although at a costlier level, but there's no problem there too in revolving or servicing the debts. Now, what we see is basically a currency substitution by domestic residents, both from corporate and private. Now, let me give you two figures to explain what the situation is. Now, this is the real effective exchange rate. It doesn't show the last bit. In other words, it doesn't show the December rate. The December rate is probably something like below 40, yes. Now, it shows that historically, the real effective exchange rate had never been, since 1994, as low as this. So there is a very depreciated, over depreciated exchange rate. So the national currency is at its lowest real level. So this is quite a problematic area indeed for the economy. Now, the reason why the policy rate is being reduced by the central bank is they have been ordered by the president that they should there should be lower interest rates to induce a higher growth rate. But we see two things in this order. One, we see that the monetary authority is no more independent. The monetary authority had lost all its professional expertise and independence and technical expertise in implementing monetary policy. And secondly, we see that policy had been quite detrimental for the interest rates. Now here, in this slide, you see the reduction of the policy rate from 19% gradually to 16%, then to 15%, then to now currently it's 14%. So there had been a decline in interest rates by the central bank, but that is just the policy rate of the central bank. And when we look at the other interest rates in the economy, for example, the loans given to the individuals for their general need, there isn't a significant decline in the interest rates. If you look at the loans given to individuals for automobiles, you see that there is a rise recently, yes. And if you look at housing, there is a slight reduction, primarily by the public banks, because the public banks are kind of made responsible, or they feel that they have a duty, a political duty indeed, that they should provide cheaper loans to the housing sector. What we mean is the consumer loans, and naturally we're talking about the consumer loans. And if you look at general commercial loans, and this is corporate credits we're talking about, there isn't, if we are talking about the recent 3 months, there isn't a significant reduction in the interest rates. And when we look at the Treasury's borrowing rate, it had surged by almost 4 or 5%, despite the reduction in interest rates by the central bank. So there is no evident reduction in the consumer loans of or any kinds of loans by the banking sector, or the borrowing rate of the Treasury. So the decline in interest rates by the central bank had been detrimental in its counter-inflation policy, but the central bank has announced that it doesn't aim at inflation anymore, but it aims at balance of payments. So unconventionally, the central bank of Turkey has lost its main objective of price stabilization. Now, why did the foreign currency deposits rise? Now, this is a very crucial issue. Now, we can understand why they rose. There are two reasons why the ratio of foreign currency deposits rose as a ratio in total deposits. One is that as they are measured in Turkish lira terms, yes, I mean, when the currency rate depreciates, naturally, as a proportion, the foreign currency deposits rise, no matter how, if they rise in dollar terms or euro terms. Yes, even if they remain the same, there's a rise due to the exchange rate. But for example, when the exchange rate was stable, yes, the currency deposits, for example, in 2001 crisis was almost 62%. Then they declined until the 2011, which was rather stable years after 9/11 case and after the global currency of 2008 and 9. They had declined to a tremendous level of 28%, which could even be furthered to even less figures, but it didn't happen. But since 2011, when the exchange rate started rising, individuals saw that they should switch to foreign exchange deposits. And now, in the last 10 years, the exchange rate has depreciated nominally by more than 10 times the FX deposits as a ratio of almost 64% in total. Now, this is quite problematic for monetary policy because the monetary authority loses its control over the money supply. Now, one of the consequences of this depreciation is that when the national currency depreciates to such a level, it perils the foreign debt servicing. Now, the foreign debt in Turkey is $446 billion, which is roughly about 60% of the GNP. Now, this is quite high, yes. Such a foreign debt ratio causes a stringence in debt servicing problems. Now, we know that the debt has risen almost 70% due to the 70% nominal depreciation of the exchange rate. So this debt is roughly about $290 billion in Turkish lira terms, which is 3 years government revenues, almost even higher than the 3 years government revenues. But naturally, government revenues will not be allocated for foreign debt payment. and the foreign debt isn't going to be paid right away. So there is the long-term foreign borrowing, which will be paid later on, maybe when the national currency appreciates to a certain extent or reappreciates to a certain extent. Now, this figure is quite important because it shows the CDS of 5 years. I believe it is very peculiar because, as you see, the CDS of Turkey is above 500 basis points, which is very, very high indeed. Generally, emerging countries have a margin of 200 basis points as a CDS, but even less. I mean, there were times when Turkey was paying 150. But now we see 500, 550, which is very high. And that means that the debt servicing will be costlier and costlier each time since 2018. Now, here you see a graph for the public sector, that the Treasury backed or guaranteed foreign borrowing is rising, and it's almost $15 billion. And this is a picture, this is a phenomenon which had emerged since 2006, but especially after 2015. Hardly difficult, very hard to be understood. Now, devaluation also caused a tremendous rise of debt, public debt. I want to underline this and emphasize this because the public debt is a large debt, and a large part of the foreign debt is comprised of public debt. It wasn't. It was 2/3 private debt until 2018, but since 2018, the private sector reduced its foreign debt by almost $80 billion. So they repaid $80 billion. So the private sector foreign debt is much less when compared to pre-2018. But after right now, the public sector foreign debt is much higher. So the total, to such an extent that the total foreign debt is no less than the past. So something was going to be rectified or remedied by the private sector, but it's even worse by the public sector. And indeed, what we also observed that the private sector saw that there could be a fast rising national currency depreciation or foreign currency depreciation, national currency depreciation. So they kind of took the precaution and prepaid their foreign debt and reduced their foreign debt burden. Now you see that the public debt, the net public debt, this is the net public debt in billion Turkish liras, was not quite problematic until 2017. So since 2018, there is a sharp surge in the public net debt, especially in 2020. Now, these are quarterly figures, quarter one and quarter two. I mean, have a look at the difference between quarter two and quarter one. It is roughly about 10%. A 10% rise in each quarter in public debt. That's a very high rate of increase, and it's an alarming one. Now, here you see the Treasury borrowing rate. As you see, it was quite aligned with the cost of borrowing and the borrowing. Now, here you see that this is the most important one, that it is, I mean, it was 18.49, but now it's 22.8, which is very high. I did show you in the beginning of this session. Now, I want to show you this, this figure because it's an alarming figure. It's a horrible figure because it shows what happened to public debt. I mean, a lot of people are talking about that. What is happening in currency substitution is that it's causing a pass-through. The depreciated exchange rate is causing a pass-through consumer price inflation. But in this presentation, I want to underline or illuminate two important or address two important dangers in this crisis we are faced with. One is on the public debt, which is this one, and the other one is the fast slowing down of the fast slowing down of the economy in the preceding months, which is probably by the first quarter of 2022. Now, this is a simulation made by the Treasury of the Turkish government, 2019 and 2020, both. Now, the blue sticks or holograms show that when you have a 5% depreciation of the exchange rate, 5%, it increases the public debt national income ratio by 1%. Yes, but it also causes, but a 500 basis points reduction, increase in interest rates causes the public debt to rise by 0.7%, which shows us that you should be very careful on the exchange rate rather than the interest rate. Yes, so increasing the exchange rate is quite disastrous, or more disastrous than increasing the interest rates. Yes, so you shouldn't much care about the increase in interest rates. If they rise, the detrimental effect or the negative effect is, or the adverse effect is much less than depreciation. And what happens if the growth rate declines by 2%? Yes, this is about the domestic debt dynamics. Now, we know that in Turkey in 2021, there was a depreciation of 65 or 70%. So we should expect the public debt to rise by 7%, yes? Even more, isn't it? No, this is about 5%, assuming that it's 70%, so it means that it's 14 times. So the public debt to GDP ratio should rise by 14%. Yes, a 14% rise of the share. Yes. Now, what happens if there is a rise by 14%? Yes, because we know that there had been a depreciation. Yes, there had been some reduction of interest rates, but it had not affected the domestic debt. On the contrary, the Treasury borrowing rate had gone up. So there is a further increase in public debt here. And at the same time, as the rise in interest rates will contract the economy, so we should also observe another negative effect on the public debt national income ratio. But I just calculated what it is on the public debt just caused by the devaluation, assuming that there is 65% devaluation, as there is a $207 billion of public foreign debt. The net effect on, or the additional burden on the public debt is 1.9 trillion Turkish liras. But we know that there's also domestic debt in foreign exchange by the Treasury, which is basically about $34 billion. And that adds up to 309 billion Turkish liras as an additional burden. Now, when there's a devaluation, there is also quite marginal, but still, some additional burden in Turkish liras too, because the interest rates may surge up too nominally, and that is another 20 billion Turkish liras. If you add them all together, it's roughly about 2.2 trillion Turkish liras. Well, if that is so, that means that the 1.75 trillion Turkish liras budget will be insufficient if it's completely directed or allocated for just servicing the additional burden of public debt. That is insufficient. I'm just trying to show you that the size is enormous. Yes, the rise in public debt. So we are really in a troubled position. Yes, and something has to be done. Now, we know that the pass-through and the deterioration in the public debt dynamics can be remedied by fiscal discipline. And if there is strict fiscal discipline, in other words, if the primary surplus is strong of the budget, then the detrimental or negative or adverse effects will be much less. But we know that during the pandemic, frugal fiscal discipline or fiscal policy was quite difficult. So there was an kind of unleashed and quite understandable fiscal relaxation for helping the deprived social sectors during the pandemic. Now, this is a very important one. Foreign investors deserted the Turkish lira market. So I'm just trying to show you that there isn't a currency attack, because they had already deserted the country much before this current crisis. Now, this is the fiscal discipline. Now, here you see the public sector primary surplus as a ratio of national income. Now, as you see, between 2002 and 2007, there was a high primary surplus. Naturally, 2009 crisis, during 2009 global crisis, there was a deficit to help the economy, but there was a recovery after this, the global crisis. There was at least 0.5%, sometimes 1.6% of primary surplus. But since 2016, peaking at 2019, there is a primary deficit, yes, which is quite alarming indeed, because I understand that in 2020, there can be a primary deficit due to the pandemic. But 2019 is another case. I mean, it should be less in 2019. It should be slightly more in 2020. And then starting from 2021 and 22, it should be reduced. But it's not the case. So we can't talk about a very strict fiscal discipline. Now, this is the European Union defined budget deficit as a ratio of GDP. As you see, since 2011, it doesn't satisfy the Maastricht criteria, which is of 3% of GDP. Now, I have to tell you I have to show you what the current state of the society is and how what is going to happen into 2022. Now, we can well understand that because of the pass-through, the inflation will surge enormously, and we'll have a very high inflation rate caused by global factors, caused by the pass-through of the exchange rate, which is on the supply side, but also from the demand side too, because of the high wage rises and monetary expansion, because the monetary expansion is quite high in the last 1 year. There's a rise of 50% of the central bank money, which is the high-powered money, but also the widely defined money supply, which is M3. So both we can talk about both monetary expansion and also fiscal expansion alongside the supply problems, yes, wage and other cost rises. And we know that the global, there's a global rise of commodity prices like petrol prices, natural gas or shaft gas prices, which we import a lot, and also some commodity prices like metals and other food prices, which we import too, right? Wheat and so on. So there is a rise in all global prices alongside the domestic prices, which kind of augments the inflationary pressures. So we're going to have a rising and continuously rising inflation rate in 2022. But what will happen on the growth side? Will this be just an inflation, or will that be a stagflation? Now, when there's a kind of hybrid and high rate of inflation, we generally expect that there will be some stagnation at the same time, alongside inflation, which we call stagflation. As this inflation is not just a demand pull inflation, as there are many factors which make it supply-sided too, this will be stagflation, but at the same time, this can also be verified by the Consumer Confidence Index. Now, this Consumer Confidence Index, provided by Bloomberg HT in Turkey, and this figure starts from 2002 by a base figure of 100. During the rosy years between 2003 and 5, you see that there is a rise in this confidence index of almost 130, by 30% rise, but then there is a decline, yes, and the decline had become quite sharp in 2008 and 9 when there's a global crisis, and during the global crisis it declined to really low levels. Now you see, yes, when the global crisis was sharp, it went down to 55, yes, but currently it's well above 44 or 45. Now we are in a position much worse than 2008 and 9, which forecasts us or foretells us that we're going to experience a rapid contraction in consumption. And as this is quite structural, as it's going for a long time, we should expect that the propensity to invest would also retard to a large extent. So I want to show you, I want to summarize the syndrome we are going through, that we are going to enter in a stagflationary environment. But this stagflation environment will be quite a sharp stagnation, as well as a very high rate of inflation ignited or induced by sharp rises in the general cost level of the Turkish economy. So let us remain here and try to see what is happening in the financial markets in the coming days. We know that there is there's cash withdrawals from the banking system, although not intense, and that's why the central bank is continuously intervening in the foreign exchange market to provide the foreign exchange liquidity to the banking system, so that this cash withdrawal propensity of individuals and corporates are met. Although I believe that Turkey does not carry any foreign exchange problem in amounts, but the problem is basically confidence. The confidence generally, and the confidence in the banking system, and the confidence to the exchange system, foreign exchange system. Now, there is a fragility there. There is a very high unconfidence or loss of confidence in the system, which has to be rectified. by the authorities, but then again, they lack credibility. Now, we are in a very stringent position, but I am sure rationality will win. And at the end, authorities will recover what they should do or what they ought to do. Okay, thank you very much for listening or watching this important issue and important topic, which Turkey is going through. I'm sure one day, maybe in a better day, we shall be together and talk about good things, not bad things as today, okay? Things will not be as bad always. Good days will come. And we shall have better and more positive shares, hopefully. Okay, bye-bye now. And I want to cut it now.